Listen carefully, because what I'm about to tell you is affecting hundreds of thousands of senior homeowners across the United States right now. The IRS mailed compliance warning letters to over 400,000 senior homeowners across 12 states in February 2026. And if you own a home and collect Social Security, there is a real chance one of those letters is heading to your mailbox right now. These are not scam letters. They carry official IRS letterhead, reference CP 2000 and LTR 5071C notice codes, and they target a very specific discrepancy the agency started flagging last fall: unreported or misreported income connected to property tax exemptions, homestead credits, and the way your Social Security benefits interact with supplemental income tied to your home. If you received one of these letters, or if you live in one of the 12 states Floyd is about to name, you need to understand exactly what is happening before you respond. Here is the single most important thing Floyd can tell you right now. If you are a homeowner over 62, receiving Social Security, and you claimed a state-level property tax exemption or homestead credit in tax year 2025, the IRS may be treating the value of that credit as unreported income. That means your federal tax liability could increase by anywhere from $1,200 to $3,800 depending on the size of the credit and your total combined income. You do have the right to dispute this. You have the right to file a response showing that the credit is excluded under your state's classification. But you must respond within 30 days of the letter's date, or the IRS will assess the tax automatically and begin collection. And Floyd is going to show you exactly how to respond, which form to use, and how to make sure you don't pay a single dollar more than the law requires. But first, you need to understand why this is happening in 2026. Because the reason goes deeper than just a simple letter. The 12 states currently affected are California, Texas, Florida, New York, Illinois, Pennsylvania, Ohio, Georgia, Michigan, North Carolina, New Jersey, and Arizona. These are not random. These are the 12 states with the highest volume of senior homestead exemption claims filed in tax year 2025. The IRS cross-referenced state property tax records with federal returns using a new automated matching system that went live in September 2025. Before that system existed, the IRS rarely looked at state-level property tax exemptions. They didn't have the technology, and they didn't have the staff. That changed last year. The agency received over $3 billion in new enforcement funding as part of a continuing resolution passed in late 2025. And a significant portion of that funding went directly into data matching technology targeting what the IRS internally calls passive benefit discrepancies. That's their term for money or benefits you receive from a government program that might, under certain conditions, affect your federal tax calculation, even though you never thought of it as income. Now, before Floyd continues, if what you just heard made you feel uneasy, that's because it should. Most retirees are losing between $2,000 and $5,000 every single year to IRS rules they never even knew existed. Floyd spent 28 years inside the system watching this happen again and again. That's exactly why on Seniors Update Hub, everything is explained in plain English, so you don't lose money just because the system is complicated. Now think about it this way. Imagine you've been shopping at the same grocery store for 20 years. Every week, the store gives you a senior discount. You didn't ask for it. It just started appearing on your receipt one day, and you've been getting it ever since. Now imagine one day, the store sends you a letter saying that discount counts as store credit, and store credit counts as income, and now you owe taxes on it. That is roughly what is happening to hundreds of thousands of senior homeowners right now. The property tax exemption you received from your state, the one you applied for years ago, the one that reduced your annual property tax bill by $800, $1,500, even $2 for 100. The IRS is now asking whether that exemption created a taxable event on your federal return. Now Floyd wants to be very clear about something. In most cases, state property tax exemptions are not federally taxable. The IRS knows this. But the automated matching system does not make that distinction cleanly. It flags the discrepancy. It generates a notice, and then it becomes your responsibility to prove that the exemption is not taxable income. The burden falls on you, not on the IRS, not on your state, on you. And if you don't respond correctly, or if you don't respond at all because you thought the letter was a scam, The IRS will assess the additional tax, add interest from the original filing date, and in some cases apply a negligence penalty of 20% on top. This is not about politics. This is not about one administration or another. This is about a federal system that received a major technology upgrade and aimed it at the easiest targets. People on fixed incomes, people who file simple returns, people who are less likely to hire tax attorneys. Floyd saw this pattern over and over again during those 28 years inside the system. When new enforcement tools come online, they don't go after the most complex cases first. They go after the highest volume, easiest to process cases. And right now, that means seniors with Homestead exempt the IRS automated underreporter program, the one that generates CP 2000 notices, processed over 2.1 million cases in fiscal year 2025. That's a 34% increase compared to just 2 years earlier. This program matches information from third-party sources, your bank, your employer, your state government, against what you reported on your federal return. When it finds a mismatch, it generates a proposed adjustment. The letter tells you what the IRS thinks you owe. It gives you 30 days to agree or disagree. If you agree, you pay. If you disagree, you must submit documentation. If you do nothing, the IRS treats your silence as agreement and sends a bill. Now here's where it gets dangerous, especially for seniors. A CP 2000 notice is not a bill. It is a proposal, but the language in the letter is designed to feel urgent and final. Many people over 65 read it, see a dollar amount, panic, and either pay immediately or ignore it completely because they think it's a scam. Both responses are wrong. Paying without reviewing means you could send money you don't legally owe. Ignoring it means the IRS can assess the full amount, add penalties and interest, and even begin withholding from your Social Security. Let Floyd tell you about Margaret. Margaret is 71 years old. She lives in Florida. She receives Social Security survivor benefits and owns her home outright. Her homestead exemption reduced her property taxes by about $1,900. Then one day, she received a CP 2000 notice. The IRS claimed she had $1,900 in unreported income. She almost threw it away, but she didn't. She responded properly, provided documentation, and 6 weeks later, the IRS withdrew the adjustment. She owed nothing. Now imagine if she had ignored it. That money would have been taken automatically. Now ask yourself this question. Did you claim any kind of property tax exemption, homestead credit, or senior benefit in 2025? If you did, and you live in one of those 12 states, you need to watch your mail carefully, because more notices are coming. The IRS sends these in waves, and another round is expected. Now here's what the IRS doesn't clearly explain. There's something called the tax benefit rule, and this rule determines whether a state tax benefit becomes federally taxable. Here's the key idea. If you took the standard deduction, then in most cases, your property tax exemption is not taxable. And here's the critical fact. About 78% of seniors now take the standard deduction, which means most people receiving these letters may not owe anything at all. But the system doesn't check that properly before sending the notice. That's why you must respond. Now here's your protection plan. Check your mail daily. If you receive a letter, read it fully. Find the deadline. Then check your tax return. Look at whether you took the standard deduction. If you did, that's your strongest defense. Respond clearly. Attach documentation. Send everything properly, and keep copies. If you need help, there are free IRS-supported programs like VITA and TCE designed specifically for seniors. Use them, because doing nothing is the worst option. And Floyd wants to be very clear about something. This system is not designed to help you. It is designed to process you. But within that system, there are rules that protect you if you know them and use them on time. That's exactly why Seniors Update Hub exists, to make sure you understand the rules before they cost you money. So let's bring this back to where we started. The IRS sent real letters. Many of those letters are based on automated flags, not full reviews. And many of those proposed taxes are simply wrong. Now you know something most people don't. You know this is a proposal, not a bill. You know when the tax benefit rule applies. And when it doesn't, you know how to respond. And that knowledge alone can save you thousands. You worked your whole life for your money. You earned your home. And you deserve to protect both. Stay informed, stay alert, and stay connected with Seniors Update Hub, because what you don't know can cost you. But what you do know can protect everything.